MAPC. Nice. I saw some of those reviews on eBay, MMA. I'm not sure. It seems like your day's been a little rougher, man. I don't know what's up with some of the products you've been selling. Hope you're all right over at home, man. I'm doing well, Julian. We'll give it one more minute. I know I started a couple minutes late. Sorry about that. I don't know if you guys were in here earlier, but I think Zoom disappeared off my computer. At least that's my excuse that I'm going to give tonight. So we'll roll with that. All right. Well, it's a couple minutes after the hour now. So let's get right into it. Awesome, Junior. I'm happy to hear that. All right, everybody. So welcome in. Tonight is the third out of 12 classes of our beginners course series. So still got a long way to go. Just as kind of a quick recap and kind of a reminder of where we're at. Our last two classes, we covered stock options basics and the Greeks. So kind of two classes on really the complete basics of everything. And now we're starting to move into some real work on the charts now. So it's becoming a bit more serious. If you miss those first two classes, now we're really past the kind of stone cold basics. So it's starting to get a little bit more complex, but today should still be mostly a smooth introduction to everything. And just as a reminder, as always, our goal for this course series, hopefully by the end of this 12 weeks, you will feel as though you are a more successful trader who can find and execute on the highest probability trades and act on those opportunities with confidence. Now, again, a couple things that I want to just go over before we begin as always. Just a quick kind of let me know in the chat, how many of you have been in the last few classes, last 1 to 2 classes? How many of you have been to either one of those classes, just so I know how much I need to kind of introduce from scratch and what you guys are already familiar with? Cool. Okay, so a lot of returning participants. Okay, awesome. Rewatch your recordings. Awesome. Great. Okay, so I won't start from the kind of stone cold basics of how this class is laid out, but just as a quick kind of reminder / warning, I like to fill these classes with as much information as I could possibly fit in about an hour. So I do everything I can to simplify it and make it presentable, but if I ever cover something too quickly or you want me to go back to something, just go ahead and put a message in the chat. I'll make sure to get to it as soon as I can. And yeah, let's get right into it and start with just kind of the high level introduction into what the big idea of this lecture is and kind of a guiding principle for the rest of the more technical portion of this course series. So kind of the big idea of technical analysis as a whole, kind of something I alluded to in the last few lectures, is that all technical analysis is stacking different kind of probabilities or reasons that a trade may be successful in our favor, right? There's no kind of one size fits all or one specific indication that we can look for and say that we will 100% be correct on any given trade, right? That's not going to exist. So today we're going to talk about some specific patterns with candlesticks that we can look to identify and use within our technical analysis and our trading systems. But I want to just be very clear. Using this specific tactic or the principles that we introduce in this lecture alone is not sufficient for a trading system. And I want to be clear, using this topic that we cover tonight and any topic that we cover in future lectures alone is not enough, right? You can't just look at candles. You can't just look at levels. You can't just look at volume. You have to look at the whole picture, right? And that includes things outside of technicals as well, right? That includes fundamentals, that includes broader market impacts, that sort of thing, right? So there's no such thing as a kind of one piece of analysis that you can look at and say, yep, this is everything that I need. I can trade based off of this one signal and be, perfectly successful. Now, obviously, there's going to be a time and place when, maybe you look at a single signal and you're like, yep, this is pretty reliable. I'll give it a shot. And you can try and define a higher quality trade off of that. But fundamentally, a lot of the principles that we talk about, again, volume, levels, price action, trends, candlesticks, flow, fundamentals, right? Going down the list, those are tools to be used as part of a larger strategy, right? So these kind of systems that we talk about in this lecture and in all future lectures shouldn't be things that you use all alone or all kind of on their own. And the last thing that I want to mention is kind of more of a quote or an example, which is a perfect candlestick pattern which is in the middle of maybe a trading range, will consistently lose money, right? You can't just be looking to one specific indication, right? You need other reasons for taking whatever trade you're looking to get into, such as confluence, right? It could be, as I mentioned, support and resistance, volume, etc. Right? So we're going to talk about those rest of those principles as we go throughout this course series, and we're going to continue to kind of build systems that use different aspects of each part of these individual lectures. But about the next 3 to 4 lectures, let me look back. Yeah, about 3 to 4 lectures. Well, I guess 3 to 6 lectures. We're really going to be building those initial tools to put in your tool belt for technical analysis, right? So candlesticks, support, resistance, price action, and volume, indicators, trends, and patterns are all things that should be used in conjunction with each other, right? And give or take, you don't need to use every single one, but fundamentally, they're all important together. So let's move on and start talking about the basics. I want to start by asking a question. How many of you have actually seen a candlestick chart before? Something like this. How many of you have seen a chart such as this one before? Anybody seen this type of chart before? We got at least one person that's seen it. Shiv, seen it. A couple people, yeah, decent amount of people have seen it. Okay, so some of us are pretty familiar, at least seen one of these charts before. So it's not brand new. I'm sure even more of us have seen a chart that looks something like this. I'm sure everybody's seen a chart that looks similar to this. You know, just a real basic line chart. Obviously, there's a couple indicators on here, but that's I should get rid of that so it's a bit more clear. Real basic line chart. All right. So let's just quickly talk about some of the basics of candlesticks, kind of what they are and what they represent. I'll blow through this a bit since it seems like a lot of you guys are familiar. So candlesticks represent historical and present price movements, right? So all these items or little boxes on the chart can be referred to as candlesticks or candles, are kind of the two common names you'll hear from them. And generally speaking, it represents price over the past and also price in the present. And what I mean by that is if we look at an instrument that's trading live right now, such as ES, the S&P 500 futures, and we go to something that looks a bit better here, and we'll just drill down to the 1 minute chart, we can see over the last, it looks like this is all throughout today, it shows us a 1 minute kind of look into each 1 minute throughout the day, right? So this is starting back at, what time is this? 3 p.m. my time, so that's 6 p.m. Eastern, I think, 1500, yeah. Had to convert that really quick. So this shows the last few hours of price action on the S&P 500 futures. And if we look right now, we can see on the far right of the chart, we can actually see this candle that's currently open changing every so often, right? So it's reflected all the price action that has occurred over the past couple hours, and it is currently reflecting the price action that's occurring right now. So we can see kind of what's going on in the market. Again, it's after hours, it's the 1 minute, so it's not gonna look like anything too pretty. But if we stared at this for a little bit longer, we would see this kind of change more dynamically. And what we could even do, just kind of for our reference today, is we could take a screenshot of what the chart looks like right now. We'll put it in the chart, and we'll put it in the chat, and we'll come back to it later to see kind of how things have changed. So this is a candlestick chart, and a couple things to note. There's 2 time frames that you can use when looking at a candlestick chart. There's the time frame that is effectively the overall period, so the start and end date on your x-axis here. And then there is the period of each candlestick or each bar. So again, if we go back to our chart here, this is showing the price action from today, which today is now after hours, and the 1 minute time frame. So each one of these candlesticks is 1 minute in time, and this shows all of today's price action. And if we zoom out to the 1 year, 1 day chart, this shows us price action over the last year, and each one of these bars represents a single day of price action. Cool. All right, again, it's just some real basics here. I know a lot of you have seen this, so I'll blow through this again. 2 main types of candlesticks, couple different names for them. You could call them bull or bear candlestick, green or red candlesticks, up or down candlesticks. I'm assuming the naming scheme is pretty intuitive, right? Your up or green or bullish candlesticks are going to be this green bar on the left, and your bear or down or red candlesticks are going to be this red candlestick on the right. Let's start with the more simpler piece, which is the highs and lows. The highs and lows of each candlestick represent the high and low price within a period. And these are the same between both bullish and bearish candlesticks, right? The highs and lows are reflected in the exact same manner. The only difference between bullish and bearish candlesticks is the change in position of the open and close price. And I'm hoping this is reasonably intuitive. A green candlestick represents an increase in price over a period, which means the closing price, which is the end of the period, is greater than the open price. So again, if we just take a quick look back at our reference here and zoom in on a couple time frames or a couple bars here, let's just look at this red bar here. The open price of this candlestick was about 55.70-ish, and the close price was about 54.70. So it opened higher than it closed, meaning the price dropped through the period, which is why the bar is painted red, right? And we could see basically an opposite bar right before it, where we have a green candlestick opening at about 5,400 and closing at about 55.50, which represents an increase in price over this daily period. And if we take a look at today's candlestick, or I guess now yesterday's candlestick on the futures, it started at about 60.30 and closed at about 60.90. And if we look at what the S&P did today, SPY, we could see that reflected about a percent gain in the S&P today. So candlesticks are reasonably intuitive. The colors that they paint themselves are reasonably intuitive, right? They're green by default when the price increases, and they are red by default when the price decreases. Now, you can certainly change the way these things look. I can't remember if I have anything pre-saved that's automatically going to change this. Yeah, so I mean, sometimes you can change the way the candles are colored, but that's not super really important. That would be up to you to change, but all you really need to know is green candlesticks represent an increase in price and red candlesticks represent a decrease. Any questions on that? A way to zoom in like that on Webull. It's a great question. Wish I knew the answer to that one. Not sure. Do not use Webull. I do not, I should say. All right, we'll keep rolling. Again, I'll blow through this a little bit quickly. I'm assuming a lot of you guys have seen this. So there's kind of two main parts of a candlestick. There is the body of a candlestick and the wick. The body is basically represents the open and close price, and the wicks represent the extremes, so the highs and lows. Pretty simple. All right, this graphic is probably the most important thing I'm going to show you all night. We're going to talk about a lot of specific candle patterns throughout the night, but this is the idea that drives kind of what candlesticks mean. So if you're going to learn anything from this lecture, it's basically going to be right here. So it's a really simple graphic, but basically this is showing kind of the strength of candlesticks from left to right. Starting with a more simple example, right? What's being called a strong candlestick is a candlestick that opens basically at its low and closes basically at its high, right? This is basically telling us that there were no bears throughout this period, right? No sellers throughout this period is another way to think of this, right? Our open was the low of day and our close was the high of day, meaning that buyers were aggressive throughout the entire day, right? They were relentless. Moving on to something that's a bit weaker, right? And this is very minor, but there's a small downside wick here, meaning at one point there were some sellers throughout the day, but they were ultimately overwhelmed by buyers, and we closed at the high of the bar. And you can see as we continue throughout the scale, we get longer wicks on both sides of the bar and smaller bodies. And the weakest bar of them all is basically, or should I say the weakest bull bar of them is a candle where the open is basically the same price as the close. So at some point, bulls made a significant amount of progress throughout the day with a nice move higher, and bears really stepped up and drove price lower throughout the period, indicating that there's more sellers in the market than maybe were originally there in the earlier part of that period. And the reason that this idea is so important is this is the sort of idea that allows us to look at a chart, for example, and determine if we have some kind of strong breakout, strong bounce, strong hold of a level, right? And let's just kind of clean this chart up real quick, just to go through a few examples. This is the S&P 500 ETF. And automatically, I see a couple very strong bars on this chart, right? Here, I see one. Here, I see one. Here, I see one. Here, 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 and here. What do you guys notice that's in common with every single one of these kind of significant candles? And maybe I cherry picked a couple of them here, but the point still remains. What are you guys seeing every time we see these kind of really strong bars in either direction? What are something that you guys notice? And Rudy, we will get to that probably not today, but depends on how much progress we make. We might not talk about every single candlestick pattern. We can start to introduce that. Eli says reversal. Jomo says big movement. What else? What other ideas? Any other ideas or thoughts? Reversal. Yeah. I mean, the answers that are in the chat basically already covered it, right? Big movement, certainly important, right? Almost no wicks, absolutely. The thing that I really wanted to call out here, though, is that these significantly oversized candlesticks basically are always corresponding to significant highs or significant lows, right? Over the past 3-month period, pretty much the only time we see these really significant bars that are, very clearly larger than all others, like, the average size candlestick is maybe a couple bucks on the spot, maybe a $5 candle. This is a drop from 550 to 540, $10 candle. Drop here from 552 to 542, $10 candle. Drop here, 560 to 552, almost 10 bucks. This has a really long downside wick, but an overall move from 540 to 555. Here, massive drop from 603 all the way down to 585. The thing in common with every single one of these cards, or every single one of these significant candles, is this is a massive inflection point in price, right? This is where we see price effectively U-turn and start heading in the other direction. And there's absolutely no coincidence behind that. And this is a concept that we're going to continue to build on throughout the lecture series. But this is one of the more important things to understand when reviewing charts. And kind of more important than any pattern or any other idea that we may talk about is understanding the concept and why this sort of thing matters. The interesting part about candle charts and price charts in general is that market participants can't hide their behavior on these. And what I mean by that is if people are taking massive sells or sales of a given equity, you can see it on the chart. If people are taking massive buys of a given equity, you can see it on the chart. So for example, here, when we see people taking massive sells of the SPY, right, hitting new lows, breaking this prior pivot here on rising volume, it's no secret, right? We can see all those things. Here, same idea, right? Price, big bearish engulfing, price closing near its lows on above average volume. There's no secrets there. Here, price hitting significant multi-week lows on the highest buying volume in almost the whole year. That is not by accident, right? There is a reason a bottom formed here. Same idea here, right? Above average volume, bull bar closing near its high after this massive wick lower. This is a significant inflection point. Here, massive bear bar. This is the most sell volume we have seen basically in a year. You shouldn't be surprised that price continued a little bit lower and even further lower after that, right? This isn't something that happens just on accident, right? These candlesticks represent the people in the marketplace who are buying and selling. And our job, if we're looking at candlesticks, is understanding what these charts are telling us, right? Nobody in this lecture and in the market in general who's really successful should be in the game of predicting what's going to happen. Instead, you can very easily react to what has happened. For example, when you see a significant bottom, such as this form, on amazingly above average volume, not the strongest bar, but amazingly above average volume, maybe you don't get long the next day, maybe you don't get long the same day, but you damn well shouldn't be short anymore. And same idea with this bar, right? After a massive bear bar, the most significant candlestick we've seen in an entire year-long period, looking at this chart, we have not seen a bar like this in a whole year. The only comparable ones are here, here, and here, and they're still not even close, right? After a bar like this, maybe you don't go short the same day, maybe you don't short the next day, but you damn well shouldn't be trying to long that, right? You should absolutely be a little patient and wait for the market to carve out a bottom, right? So candlesticks can be really, really, arguably beautiful ways for us to identify times and places for us to get involved with added risk in the marketplace, or when it's time to reduce a little bit of risk in the marketplace, right? Again, an example like this. A day like this, when you see a massive bear bar closing near its low, probably a decent time to sit back a little bit, relax, wait for the market to form a more sustainable bottom, right? Which it seems like at this point, that's definitely been formed, right? Nice little wedge pop, little breakout as of yesterday. Now we have the fundamental backing. Even here, right? Nice undercut of the lows and reclaim here. Definitely a nice little shakeout there. Anyway, the point isn't to get too deep into technical analysis, but rather to share the significance of candlesticks and why they are so powerful, yet so simple at the same time. Going back to the graphic really quick, I think at this point, the bearish strength side of this graphic should be reasonably self-explanatory. But does everybody understand the principles of this concept for now? I want to break it down just kind of one more time and show you guys one more example. We're going to talk about a lot of different candlestick patterns in this class. While I think it's important to just learn about them and understand them, this concept will get you so much further than memorizing, these silly candlestick patterns like this, right? Yes, it's certainly important to understand, these ideas. However, the reason that they matter to me is so much more important than, bearish engulfing, bullish engulfing. Nobody's actually trading like that. Nobody's going to look at a candle and get long because of some bearish engulfing, right? The reason that those candles matter is why people should be getting long, which is this, right? It's the theory behind those candles. It's why they're significant, right? It's not because it's just some simple pattern and we see that simple, silly little pattern and we get long. No, we understand that at this specific place, for whatever reason, right, we're seeing a bar that reflects buyers stepping into the marketplace, or that reflects sellers exiting the marketplace, or vice versa. So everybody's on the same page with me and understands these two graphics. All right. A little different than our first couple lectures, huh? Just a little bit different. A little bit more exciting for me now. Those first two lectures are fun, but it's a little bit more exciting for me to talk about these concepts, honestly. All right, I want to just show kind of one example. Let's just compare kind of what goes on in the higher time frames versus what's actually happening on the lower time frames, just to give you guys a little bit of insight. I know last lecture we talked about zooming out a bit and not focusing so much on those lower time frames, and I want to just kind of show you a quick example as to what that could look like. So I want to focus really quick on this example on December 18th, because this is a massive outsized move. And I want to just show you what this looked like on the lower time frames. So let's clean this up a little bit. Let's go here, 5 minute, and let's zoom out 20 days. That should do it. Let's see if we could find that day. It should be pretty obvious. I think we're 2 days too short. There we are. Okay. So let me clean this up just so there's no indicators on here. So it's just fully clear what's going on. All right. I'll zoom out even a little bit more. Wow, this is kind of ugly. All right, I'm going to chart one level on this. Let's put it right here. One level right there. Okay. So if we look at our left example here, let me resize this a little bit. As we mentioned already, we have a massive bear bar, right? A bar closing near its lows, small little wick to the upside. But ultimately, this is a reflection of a candlestick that is 100% not bullish, right? This is not something that you should see and instantly think, yep, this is the time to add longs. For more than, maybe a bounce into the next morning, sure, absolutely reasonable from time to time. But this is absolutely a sign to be a little bit of patient, identify the names with relative strength, and focus on something that actually has a tradable bottom. Let's look at what this action looked like on the lower time frames, and starting with early in the day, without even seeing any of this. Early in the day, right, what this bar looked like for the first basically 5 hours of the day was virtually flat. Let's just chart out the close price of the previous day, just roughly. 604.36 was the close price of the prior day, approximately. And for the most part, we were up, about 0.14% on the day, about $1. So basically nothing going on all day, right? We kind of struggled around our pre-market high around here, found some sellers here a couple times. This is basically a textbook range day. Like nothing's really going on, no real significant move in either direction. It's just really slow, frankly. Then all of a sudden, we scroll to the right and we have two, I'm trying to hide the rest of the chart here, two massive bars. And if we look at the overall range of these bars, this was a $5 move. Keep in mind, we hadn't moved more than $2 all day. It took us basically 3 hours to move $2 and 10 minutes to move about $6, right? That's pretty significant. This is what this looked like on the lower time frames, just to start. And seeing how this continued throughout the day, what this looked like on the lower time frames was massive continued selling pressure. Absolutely no significant bounce higher. Every single green candle was sold. Literally every single one. Like there was no sustained bounce the entire day. Price closed all the way at the lows. And if we zoom out a little bit and just take a peek at how the volume looked through the same time frame, try and zoom back a bit. Something stands, oops, didn't mean to do that. Something stands out on this chart from a volume perspective, and it's this day right here. This is the only day. This is 4-5 times our average volume in a single hour. So this is, in summary, a massive downside day on all time frames, right? No matter how you look at it, this is a massive move lower. Looking at the lower time frames, maybe you're not really considering. Well, I guess I got rid of how I had it set up on the 5-minute, but we'll go with that example for now. On the 5-minute, you might be so focused on what's going on intraday, but on the daily, it's a little bit more clear what was actually happening, right? You could draw maybe this tiny little uptrend here if you wanted to, but I don't know if that's super significant. But you have probably the most important level in that area right around the 602 level, right? Once you lose that, that's probably your most key support in the short term. Maybe you have a little bit of support at 600, but realistically, and I know this isn't a lecture about support and resistance, but realistically, right, there's not too much for the market to get some footing on down until that 583 level. I mean, that's really the most key pivot. And we can see the reason I called that out as a key pivot is that's the first place where we start to see some kind of significant price action on, right? We have our nice, stronger bull bars here with our bull bar with minimal wicks closing near its highs. We have these long downside wicks indicating the presence of buyers in this area. So this is really the most significant pivot in this area. And when you're so focused in on what's going on the 5-minute and you're not paying attention to the price action on a larger time frame, which is what actually matters, you miss a lot of the context. So point being, paying attention to how candles close and how candles develop on the daily, the hourly, the longer time frames adds such an important context that I think a lot of people really do miss out on when they're so zoned in on what's going on in these lower time frames. Anyway, bit of an aside, I wanted to just introduce that concept. With that, let's start to talk about a couple different candlestick patterns, things to look out for from a price action standpoint. In this section, there's going to be a couple questions that I ask you guys. We got a couple prompts that come up. We'll have some interactive questions, kind of like our last lecture. So hopefully those go well for everybody. So our first section is reversal candle. Some of you might be asking the question, what is a reversal? Well, we talked about it and alluded to it already, but generally speaking, a reversal is where price action starts trending in a new direction. And a reversal is something that is difficult to identify in the moment. I'll be transparent, right? It's very easy for us to look back at this chart and say, okay, this was a reversal right here. This was a reversal right here. This was a reversal. Obviously anybody can look at any chart and tell you what the highs and lows of it are. There's nothing special about that. However, what we can use some of these candlestick patterns and kind of candlestick theories to determine is when the probability of a reversal is higher than not. And you'll notice, right? Some people might be thinking, okay, what's the difference between these two bars, right? Oops, I'll zoom out a bit. The difference between these two bars, right? Well, the probability for reversal is going to be higher when we have that green bar, first of all, right? It's going to be nice to see, some green bar be put in at a low. And also, again, not so much the context of this lecture, but seeing that massively above average volume also increases the probability of a reversal, which is something we really didn't have the prior day. And notice here, right? We have this big bear bar lower, right? This looks pretty bad. This doesn't look like any sort of long-term bottom right here. And then we have these two bars that follow right after it, which I'll try and zoom in so we can't see what happened after. It's a little bit ugly, but anyway, we have these two bars here right after. that fully stayed within the range of the prior candlestick. Neither of those bars are very convincing, right? It's not showing any strength from bulls or bears. It's kind of just like the market's going nowhere. And then we get this candlestick with this long downside wick, bull bar closing near its high on increased volume. And lo and behold, that was the bottom. We haven't been back to those prices, right? Same theme repeats at these lows, right? Very disgusting bear bar. I'm not going to lie. This looks like we're moving lower when you see a bar like this, right? This does not look very good at all. We see, again, two candles in the same range of that bar, basically going nowhere. Then all of a sudden we get this bar where we close above the high of the prior bar. Nice bull bar. Again, not the most beautiful one, but definitely more convincing looking than this one. And even if you didn't get long there, right? And I think this was the day of the election. Once we move above those highs and retest it, there's another reason to be convinced, right? And that sort of pattern continues to repeat itself over and over again, right? Even looking at recent history. These two bars right here have absolutely no reason to have yourself think this could be a reversal, right? You have two bear bars closing near their lows. That does not look like a bottom by any means, right? This, to me, looks like sellers are still fully in control. All of a sudden, we have increasing volume. We sweep these prior lows, then have a bear bar that closes, pretty reasonably close to its highs. That looks like a short-term bottom is in, right? Moving to this example, this does not look like a long-term bottom signal, right? It just doesn't, right? There's absolutely no conviction from either side here, right? It's basically a candle that goes nowhere, right? That's not something that's convincing. I'll be the first to admit, this bar looks a bit better, right? This looks better for a longer-term reversal. It looks decent, right? We have a decent downside wick, a decent, close on the day, and ultimately didn't move higher. This bar right here is honestly not the most beautiful reversal candle I've ever seen. I'm not going to lie again, right? So it's not always perfect, right? It's not always like we're going to see, some perfect, very obvious signal form at a bottom or a low. We're just not, right? I'll say that these two candles combined look a little bit better than this one alone, right? We have this bar where we kind of gap below these lows, reclaim them, and then the next day continue to hold above them. But again, right, not the most beautiful bottom signal I've ever seen in my whole life. So anyway, that's what a reversal candle could be. So moving on to the first example, this is a very simple pattern, a bearish or a bullish engulfing. This is something that I'm sure many of you have probably heard the name of before. So generally the comment here is that any kind of engulfing pattern or all reversal candles or patterns should occur at the tops and bottoms of trends, right? Fundamentally, that's what a reversal candle needs to be. It needs to be occurring at a place that's logical or potentially logical for a top or a bottom of a trend, right? If we're just, kind of breaking down for the first time like here, it's not really where you'd like to be looking for a reversal candle, right? This is a bit more of a continuation pattern where we're kind of breaking these lows, right? This would be an example of where you want to look for a reversal candle, or here, right? And again, obviously, in hindsight, anybody can be doing this, but hopefully that conveys the point effectively. So a couple things to look for. A bullish engulfing, and I guess the term bullish in general is something that I haven't really introduced too much in detail. But when you say you're bullish on something, that means you're expecting price to go higher. And when you say you're bearish on something, that means you're expecting price to go lower. So a bullish engulfing would mean that you're looking for price to increase over some period. And a bearish engulfing would mean the opposite, right? You'd be looking for price to decrease over some amount of time. And just kind of to go into an example, right? This would be one example of a decent bullish engulfing, right? And the one thing to notice is that the previous candle is fully engulfed and obviously results in a bullish trend afterwards. But the most important thing is that the range of this blue bar fully engulfs the range of the prior bar, which ultimately results in a move higher. And let's see if we can find maybe some examples of this. This is a really good example, actually, right here. This candle right here is a pretty solid bullish engulfing, right? If we take a look at what happened here, this box that I just drew is the range of the previous bar, right? The open and close. That's what I'm calling the range right now. This is the range of the next bar. So psychologically, what's going on here, right? Well, basically, we had one day which was pretty much not impactful, nothing too exciting going on. The next day, we gapped lower, significantly lower than we closed, and then closed higher than we did the day before. which basically means more buyers are entering the marketplace, right? More buyers are arriving. And going back to one of our earlier examples, right, you could even think of this as like, an eBay auction where on the first day of the auction, price basically does nothing. And then all of a sudden the price starts skyrocketing. And again, not exactly a perfect analogy, but basically what that reflects is demand all of a sudden has suddenly increased, right? For whatever reason, right? And it could be multiple different reasons for that demand changing. But fundamentally, okay, Junior's a little bit confused. We'll keep talking about it. Let's see if we can find another example. Fundamentally, a bullish engulfing, where did that example just go? Right. Let's see if I can maybe find another example that's a bit more clear. Here would be a bearish engulfing, right? And the idea behind the bearish engulfing, I'll zoom in all the way on this example here. The idea behind the bearish engulfing, which what I'm looking at is this candle right here, highlighted in green. The idea behind the bearish engulfing is the open of the bar and the close of the bar down here fully engulf or are higher and lower than the prior bar, right? And you can see in this specific case, the open is 584.60 of this bar. The close of the prior bar is 584. The open of the prior bar is 581. And the close of the prior or the after bar is 580. So generally speaking, when you're looking for an engulfing candle, the range needs to expand, right? So the distance between the open and close price needs to be greater than it was in the prior day. And what I mean by that is on this day, the distance between open and close was about, $4. On this day, the distance between open and close was about 5 or 6, right? Meaning the overall move in price has increased. That's the first thing. And then also you want to see this kind of same centering, I guess is the best way I can put it, where the larger day or the engulfing day is fully encapsulating or covering the range of the prior day. And basically what this represents is, you could think of a game of tug of war, right? Where bulls worked really hard to tug the rope maybe 2 feet over this period. Then all of a sudden, bears showed up, worked even harder, and they tugged the rope 5 feet, right? So more bears or more people from the opposite team showed up basically out of nowhere, and then they came to work even harder than the bulls could, right? Which would be the team that was previously winning. So you could think of the game of the market or trading in general, kind of like a tug of war. And in this case, this shows us when the tide has started to shift. Basically, these engulfing candles represent large amounts of buyers or sellers entering the marketplace reasonably quickly. To be considered an engulfing candle, does it require the color change in candle? Yeah, that's actually an interesting question. I don't know if I've gotten that one before. It's very common to see the candle color change, but I guess it's not necessary. I will say it's likely a stronger signal if the candle color would change. Like for example here, right, I guess you could call this a bearish engulfing because the range of this bar fully engulfs the range of the prior bar, but there's no real signal going on here, right? It's not really a reversal pattern. The trend has already kind of started to shift down, so there's no real reversal developing here. Let's see if I can find a couple more examples just to kind of solidify this one. This is a decent one. Let's see, where was that? This is a decent one here. Similar idea, right? Notice how the range of this green bar fully engulfs the entire range of the previous bar. So not only does it engulf the body of the previous candle, it also engulfs the wicks. So the full range of the prior day is engulfed by this current day here in green, which again signifies that bears spent, the whole day making less progress than the bulls made the following day, indicating that in the market at that given moment or on this given day, bulls ended up being stronger, which is something that you want to see at a reversal, right? Something that you want to see for a pivot is you want to see that sort of changing momentum, right? You want to see one side start taking control over the other. Does that make sense? Explained in a little bit of a different way there. Yeah, volume in that particular example is definitely not ideal. Doesn't make a difference. To be honest with you, if I was looking at this in real time, I probably wouldn't give too much weight to it. And that's why we can't necessarily look at these patterns alone. But the price action was a good example, which is why I picked it. But 100% agree with you there. Volume is definitely lackluster. Cool. All right, let's do a quick check-in on our prior ES example. I know we talked about just kind of comparing it real quick. I want to just open this image. So this is what our ES chart looked like about, I don't know, 30-ish minutes ago. Let's check in and see what we're looking like now on the 1 minute, just so we can kind of see how those candles have developed, mostly just out of quick curiosity. So about 30 minutes ago, we were right around here, and we could see how the price action has developed over time. So we can see it looks like we've gotten, again, this is the 1 minute, so it really doesn't matter, but we've had some sellers start to enter the marketplace. I can't stress enough, the 1 minute really is not the time frame to be doing this sort of analysis, but, I guess if we were really, going by the book here, this is a pretty strong bear breakdown, right? A bear bar closing near its lows as we close through a prior pivot there. It's the 1 minute. And I think one important thing to note here is that any sort of signals that we see are much less significant the lower the time frame we go. So for example, candlestick patterns on the 1 minute aren't nearly as relevant as candlestick patterns on the daily, right? Because the daily candle represents a full day of price action, right? Millions and millions of shares are traded in a full day. The 1 minute, well, represents a single minute of price action where maybe hundreds or tens or thousands of shares are traded in a minute, right? So the things that go on minute by minute are way less relevant than the things that go on day by day, week by week, even hour by hour. All right, a couple more kind of reversal patterns to talk about here. The one thing that I want to note, the intent of this lecture really isn't to get you guys to memorize all these patterns. Sure, you could go through and understand, yep, this is the names of these candlesticks. We got a hammer, potential reversal, a hanging man reversal, blah, blah, blah. But honestly, in my opinion, none of that really matters. If you understand why something is a reversal bar versus why something isn't, and what a strong candle close looks like versus what a weak candle close looks like, that is far more important than being able to rattle off, okay, this is a hammer, this is a hanging man, this is, an engulfing, blah, blah, blah. Just want to make that clear. So hammer and hanging man candlesticks are generally characterized by long downside wicks. So if we take a look at this, the trend and context is certainly incredibly important, right? Because these two bars look the exact same, but the context or the trend before is very different, right? So these patterns are technically not the same. They don't mean the same thing, right? One would be more of a bull reversal and one would be more of a bear reversal. But the only reason that this one is a bull reversal is because we have this downtrend before we see this bar, where on this hanging man, we have an uptrend before we see this bar. So some examples of this going back to our S&P chart. Could maybe even see these on ES a bit. Yeah, this is decent, right? Check this out. Nice perfect hammer at the lows on ES, right? This is, wow, this actually looks way cleaner than the S&P, right? Very nice hammer, right? We have a downtrend coming into it. Very nice textbook hammer closing near its high with a long downside wick. That's basically textbook, right? Let's see if we could find a hanging man. I guess this is technically a hanging man, right? We have an uptrend into it here. And then this kind of long downside wick, but notice nothing really happened, right? This is not any significant top. And again, just another reason as to why these candles aren't always just the end all be all. We had a couple of these potential hanging man candles, but again, it's not something that I would even really give weight to in real time. It's not very significant. All right. Yeah, so the long downside wick basically indicates the presence of those buyers or sellers showing up, right? So remember on the hammer pattern, if we just show you guys a real example here, at one point, this bar looked something like this. 5, 8, 10. At one point, this bar looked like this, where this looks like, maybe somewhat of a breakdown, right? But at some point during this period, oops, that's not what I meant to do. At one point during this period, bulls showed up and rallied price to close all the way at the highs, which basically shows that during the period, sellers were in control, but bulls ended with control and closed very strongly. So hammer is one of the kind of more important reversals in my book. If I am going to look for any kind of reversal pattern, it's going to be something similar to this. The hanging man is personally something that I don't ever look for or care about. It's just not as strong. The one that is stronger is going to be, I don't even remember the name anymore. I think it's a shooting star where the wick is to the upside, right? So again, thinking back on kind of the theory piece of these things, right? The hammer shows us that sellers stepped in at some point during the day and bulls ended with full control. Where the hanging man, to me, it's not as strong of a reversal because it's not like this bar closed near its lows. It's not like we have a long upside wick indicating that there were buyers during the period. It's kind of just like, hey, sellers stepped in, buyers stepped in, sellers kind of won the war for the day, but it's not anything significant. So the hammer to me is much more significant than the hanging man. And we can kind of see how some of these appear, right? Generally, we see these at the tops and bottoms of trends. But again, right, it's not something that I'm looking for on their own. Definitely not looking for just a hanging man on its own. That's not a good way to go about things, in my opinion. All right. The next kind of two examples look very, very similar to our hammer and inverse hammer, or hammer and what was the other one? Hangman. Now we have what's called an inverted hammer and a shooting star. So basically what I want to say is the inverted hammer and the hanging man patterns, in my opinion, you could basically forget about them. I don't really think they're very relevant. I always find that the hammer and the shooting star are the most relevant reversal bars. And the reason being is they have these long counter trend wicks, right? They have these long wicks that are opposite the current trend. And let's see if we could find a good shooting star that kind of makes sense somewhere. I'm trying to think of where we might have seen one. Yeah, decent example here. So this is a pretty good example of a shooting star, right? Nice long upside wick here. And it didn't result in much kind of further moves lower, but it's there, I guess. Let's see. Let's see if I can find another better example. Maybe Baba could be decent. Yeah, I guess this is all right. So this would be a decent example of a shooting star here, right? Where you have this massive gap up for, it's China, so probably no reason. And sellers stepping in throughout the day. This is a pretty nice example of a decently strong shooting star, right? Massive gap up, sellers stepping in throughout the period. You got to expect that this one cools down in the next couple of days. And since it's China, it has cooled down for the next few weeks and hasn't returned to those prices yet. Probably will do something similar at some point because that's how they operate. And again, right, this is another kind of set of candles where the context certainly matters. So you're not going to have this inverted hammer without first having a downtrend, and you're not going to have this shooting star without first having an uptrend. All right, so that brings us to our first question, which it's been a while since I've seen these questions, so I don't actually remember what they are. So I got to remember this myself. Just as a kind of note, these questions are basically meant for you guys to just check your understanding. If I notice a lot of you guys get it wrong, we'll take a moment to just kind of talk through what I think the reasoning is and kind of where maybe the message got lost. But if not, we'll basically keep rolling. So with that, let's see what this question is. Okay, yeah, so it's going to pull up with an example. You're going to tell me what kind of candle is it? Is it bullish or bearish? And bonus points if you could name the type of candle. Go ahead and let me know what you guys think. Is this candle bullish or bearish? And the arrow is pointing to it. You don't have to tell me the name. You just need to know if it's bullish or bearish. If you know the name, you can feel free to put it in the chat. But honestly, I really don't care if you guys know the name or not. Doesn't make a difference to me. All right, so we got a lot of bullish. We got a couple bearish in here too. This one is going to be a bullish hammer. And the reason being, first, we have a downtrend coming into it, right? So that's going to be important. Next, we have this long downside wick and price making a pretty reasonable rally to the close. And this was a bit of a trick question because in the example, and in the other examples I've talked about, we had a green hammer, right? So if we take a look back at that ES example, we had a green hammer here, which represents where price really closed at the high of day. Where this one wasn't exactly that, right? Price didn't close at the high of day. It closed a little bit below it. However, we still have that same long downside wick. Yeah, it's definitely stronger if it is green, right? Because remember, the market's like a game of tug of war, right? And how do you know you're winning in tug of war? Well, you've made progress across the center line, right? If you're moving past the center line and the rope's moving past the center line, you know you're winning. In this example, you can think of that center line as the open price. And as we move, in this example, our team almost lost. Think of it that way. And we brought it back to the point where we were basically even, right? We basically erased all of our losses, which that's pretty good, right? That's a pretty big shift in momentum. This one, the green reversal candle or the green hammer, is basically saying we were losing just as much as we were in the red hammer. And not only did we bring it back to even, but we started winning, right? We brought it all the way back in our favor. So that's kind of the difference between the green and red hammers. I wanted to show this example just to introduce that, but this is going to be a bullish hammer. Does that make sense to everybody? Cool. And again, name, not important to me. If you guys go somewhere and say that's a hanging man, people are going to probably be like, what the hell are they talking about? But as long as you understand the principle, as far as I'm concerned, it's all I care about. All right, we're going to talk about a couple more different types of candles. These ones we're going to blow through just a bit quicker, but I want to just kind of get you guys some exposure to these types of candles. These candles are called doji candles. Generally, these indicate kind of indecision or weakness of trend, and you can hopefully understand why at this point, right? We have a significant move higher, a significant move lower, and then basically price ends up going nowhere, right? So we have both teams putting in a lot of effort throughout the period, and then we end up with nothing happening. That basically indicates that, hey, both sides are kind of trying, but there's no real decision on what's going on here. So dojis are a great time to kind of just sit back and wait for either a stronger indication. Generally speaking, they indicate continuation of trend. So if they appear in kind of an uptrend, you should expect to see that uptrend continue. Like here, you could see kind of a doji. This uptrend continues. And here you could see a doji here in a downtrend, and that downtrend continues. Here, a doji after reversal, uptrend continues. Yeah, so the dojis are basically a continuation pattern. Awesome, Ryan. I'm very happy to hear that. That's really cool. Thank you. Yeah, so you can kind of see, back to our example from question number 1, notice all these dojis right here. Price isn't really going anywhere. And the decision is made once we start to close below the range these dojis had created. So this is really more tradable than these dojis, right? Dojis really just indicate kind of nothing going on. It's just like, hey, nothing's really happening. Price isn't really moving. Nobody's really in control. It's a good time for you to just wait. The next one is, I've actually never heard somebody call it falling three or rising three. I think this is a bit ridiculous, but basically this is a general structure for a pullback in a larger trend. And I want to kind of illustrate that a little bit with a real example here. So we can see, we can kind of see that illustrated here, right? This is actually a pretty good example. So looking on ES here, check this out. We have, again, I'm going to keep going back to this massive down day because it's relevant, right? We have a massive 50, well, I don't know why I'm saying 50. We have a 3% move lower in a single day, right? That's huge, huge for the spot. It took us 1, 2, 3, 4, 5 days to retrace about more than half of it, about 3/4 of it. That's not very bullish, right? That's not something that makes you think, wow, this is a really strong market, right? In comparison, this move, we moved lower in about 5 days, and we basically moved all the way back higher in about the same 5 days, 6 days, I guess. Took one extra day to get all the way back to the ties, but 6 days high or 5 days down, 6 days back up, not really big of a deal, right? This is basically saying, hey, momentum is pretty equivalent. Here we can see that kind of weakness illustrated though, right? That very first day we didn't get much of a bounce. That next day, a little bit slow move higher. And I'll be honest, right? This definitely could have turned into a more significant reversal. But you could see that momentum kind of continue to fade, right? We get another push lower, and then again we have that same weakness on that next bounce. Really what this falling 3 and rising 3 is showing is just lower highs. That's really all it is. So we have our initial high here. That first bounce would be a lower high. Second bounce is another lower high. And as of today, we are now breaking this prior lower high and definitely starting to break that structure and looking a whole lot more bullish than we did going into the week. All right, so yeah, I'm not going to cover this too much. We're going to talk a lot more about this in our price actions class, but just to kind of get your feet wet. Inside candles, these are an interesting one. These are basically consolidation periods within a trend. So I always have trouble explaining this, but basically you could think of this like the opposite of a bullish engulfing. The order is flip-flopped. One way that somebody in the chat explained this years ago is it's like I hate saying this, I think it's stupid, but it's like the mom and son candle, like, the mom's bigger than the little son candle, or, whatever. I think it's ridiculous, but it works for some people, so that's all that matters. Anyway, you can think of it like an opposite of a bearish engulfing or a bullish engulfing, where we have the big move first and then consolidate, which you can think of it in a similar context as kind of like a doji, right? Where basically the probabilities are that we continue in the same direction that we already set out in. Let's see if there's any decent ones in the SPY recently. I don't see any recently that I can just point out. Yeah, this is kind of it. Here's one. All right, so here we have this big move lower, and we have actually 3 inside bars. And basically the way to trade these is either get long or get short once we break the range of that inside bar. So here, for example, you can see we made this massive move in one day. Then for 5 days, basically, bulls did absolutely nothing. Price went nowhere, bulls did nothing. And then once we break down from this range, that's when the move actually continues lower. So I'm not going to talk too much about planning trades. It's going to be a massive topic for multiple lectures, but that's just a bit of an introduction. So inside candles. I have some examples. Yeah, so again, you can kind of see how this works. Notice how this bar here is fully inside the range of this bar, right? And we can see hopefully some levels here. The opportunity to get long on this one is going to be right when we break above that range and then retest it. So that's the kind of idea there. I don't remember what this, let's see what this question is. Let's see if you guys get it. I know we've kind of been blowing through this last part because it's getting kind of late, but go ahead and take a crack at this. So what kind of candle pattern is this? And can you name multiple candles going on in this circle? Take a look. What do you guys see here? What's going on here? Yeah, there's a couple different patterns going on. So don't just look at the answers that people have previously provided, because that doesn't necessarily mean they are right or have everything. Kind of a lot going on here. I'm seeing some answers that I like though. I think, yeah, only one person got the more secretive one. Yeah, so basically what's going on here is we have ultimately a doji, right? It's not perfect. An inside candle after the doji, then a bearish engulfing after all of that. So basically this is like peak indecision, right? A doji with an inside candle, that means the market doesn't know what the hell it's doing. And then we see a bearish engulfing, which is basically the market getting slapped in the face and saying, I know what we're doing, we're going lower. And ultimately, right, that's exactly what happened, right? So the main answer I guess I was looking for at the time I made this was inside candle, but I mean, everybody pretty much got the big idea, which is the doji and the bearish engulfing. So yeah, nice job, everybody. All right, a couple of final things for me to mention, and then I'll let you guys loose. There's some cheat sheets online that you could use to kind of reference these candlestick patterns. They're just available free online if you're ever interested. I personally can't name a time in my life when I ever had these available for like really forming ideas outside of when I was just learning, but it's certainly kind of helpful to get an idea of, some different opportunities for bullish and bearish patterns. I don't have a copy of these, but I'll leave them up right now. If you want to take a screenshot, you can certainly take a screenshot of this one. So I'll leave it up for a couple seconds. Let's take a screenshot if you want it. And then I'll do the same thing with the next cheat sheet. Feel free to take a screenshot if you want this one. Again, as I mentioned, though, I really hope I conveyed well enough. The focus of this lecture isn't to get you guys to memorize all this. If anything, I hope you guys would understand why, patterns like this are bearish or bullish, right? This is one that I've never actually seen bullish TriStar, bearish TriStar. I think somebody just conjured that one up. I don't know what the hell that is. There's some really just wild stuff in this. There's some stuff that's like, I don't know who decided that these are what they wanted to find, but some decent examples of kind of various price action. All right, let's close this one out and talk about the next one. So today we talked a little bit about bullish and bearish candlesticks, reversal and continuation candlesticks, and we also talked about a decent amount of real market examples. In the next class, we're going to talk, wait, are we going to talk about indicators in the next one? Is that right? No, that's completely wrong. Who the hell wrote the next class? Yeah, the next class, we are not talking about indicators. We are talking about support and resistance, which I think next lecture is going to be a good time for us to get maybe a guest speaker in here. You guys have probably already had enough of hearing me for the past 3 weeks, so probably be fun for us to maybe bring River in here, or maybe, yeah, maybe Flips to start talking about some key levels and refresh the group in here a bit on that topic. But yeah, that's really what's going to be the next class. I see we got a couple questions that I'll cover before we call it quits, but just want to thank you guys for attending, and yeah, I'll catch you guys all in the next one. I'll stick around for any questions though. All right, when I was first learning to chart, did I refer to cheat sheets much? I can't remember a time when I ever really referred to cheat sheets. Yeah, I can't really ever remember referring to cheat sheets, but that doesn't mean it's a bad idea. It's just, it's not really something I did too often. If I have a second, I hear analysts in the group often mention head and shoulders. Can I quickly touch on that? I will quickly touch on that. I will say we will have a lecture dedicated to all types of patterns. Basically, to put it simply, the head and shoulders pattern has a structure similar to this, which you can kind of think of as a head and shoulders, where we set a high, a higher high, then a lower high, and all of that is structured on top of what's called a neckline. And the idea is that when you break below the neckline, that's when you would look for, potentially a short opportunity. Now, I will say this is honestly one of my least favorite patterns. I think this is absolutely ridiculous, the way that people find this to be so useful. I don't understand it, because if you look at something like, well, I guess NVIDIA isn't, well, let's see, maybe there's a better one. I remember there was one pretty significant head and shoulders on the daily, but I don't know why I can't really see it. Bitcoin is one that was a pretty funny one. People were trying to say, oh, we got a head and shoulders on Bitcoin. Here's the shoulder one, here's the head, here's the shoulder two. And people are like, all right, time to get short. And the quote unquote breakdown of that head and shoulders was the dead bottom, which is important to note, right? Look at that nice long downside wick as we swept those lows. Very nice clean bottom there. So I personally don't like really head and shoulders. I'm going to teach you guys about it. I'll talk about it. I'm not going to hide it from you, but I just don't really see the use case there. Yep, you will be able to replay the video tonight. I will show you where it's going to be available. It will probably end up in this latest lectures tab. And I think Raphael has been making a playlist maybe in the background. I don't know if he's in here tonight, but Raphael has been making us a little playlist. So yeah, it's going to live in this tab here. And it looks like the last lecture hasn't gotten uploaded yet. I'm not exactly sure why, but yeah, it should be in there. Could I re-explain the break and retest after the inside candle? Yeah, I know I kind of blew through that. Let's just go right to that slide. Probably be the best way to go about it. All right. So here is the inside candle, right? This red bar here is fully inside the range of this bull bar. And charting out just a high, because this is the direction that we ended up going, this is the high of that inside candle. And notice, and I thought I had better kind of annotations here, but basically there's a couple different types of ways that you could trade this, right? After this day that I'm moving around with my cursor, I don't know how well that translates over the Zoom, but this day here, when we break above this white line, is a potential entry long, right? We have broke this inside day pattern to the upside. That's a potential entry long. Then we come back down and retest that same level. This is another example of a potential entry long, right? This is another place where you could hop in and potentially get long. So this is basically the idea, kind of two ways to think about it. We're going to spend a lot more time structuring trades and entries and exits than just this. So I want to make it clear, this is not going to be the end of this conversation. But this is definitely not the beginning. Oh, that's not true. I don't know what I'm trying to say. I've been talking a lot to people today, and I I don't know where I'm going anymore, but hopefully that helps a little bit. Sorry, I confused myself, I guess. Cool. Well, thanks so much everybody for being here tonight. And yeah, I'll start finding maybe some surprise guests for the next lecture. All right, everybody, appreciate it, and I will see you guys all on the next one. Thank you.